Welcome to Econoday Unplugged. Each week, our expert team explains the relationship between economic announcements and market reaction. For over 25 years, Econoday has provided value for the investment industry, amassing a comprehensive, machine-readable database of global market events. Econoday provides solutions for macroeconomics, sovereign debt, agricultural commodities and historical data, all delivered via API, XML and HTML. Connect the dots with Econoday. Subscribe to the Econoday Unplugged podcast and go to www.econoday.com to follow market events.
Hello and welcome to this week's edition of Econoday Unplugged. It's Tuesday the 19th of March 2019 and with spring just around the corner, a particularly sprightly Mark Pender is across the water stateside and I'm Jeremy Hawkins here in London where at least the sun's trying to come out. Well, last week was certainly one to remember for the Brexit cognoscenti, with Prime Minister May at one point telling her own party to vote against her own motion. And with just 10 days to go before Brexit Day itself, plans for yet another attempt to get her withdrawal bill through Parliament this week look to have been scuppered. And that's just ahead of an EU leaders summit on Thursday and Friday. Meantime, back in, dare we call it, the real world of central banking, with the FOMC kicks off its March meeting today, and both the Bank of England and Swiss National Bank will be announcing their respective policy decisions on Thursday. To which end, Mr. Pender, I suppose not much on the rate side today, or tomorrow, I suppose, with the announcement, but What should we be looking for in forecasts and things like that?
Well, this is the quarterly update for the FOMC economic forecasts and their policy forecasts. And in between the last one, which was in December, we had the big pivot in January where the Fed moved, of course, from a slightly bias toward raising rates to a wait and see, could go either way. And so now it's time for these forecasts to be updated. And because they come out every other meeting, unlike now the Fed's Powell's press conference, which is now every meeting, he's been raising the issue, or it's been raised in the minutes, whether or not how useful these forecasts really are. Are they giving you something that's old, something that is getting in the way of their transparency of what it is? They have so many moving parts to their policy announcement, to the activity, to all the guidance and everything. Maybe this is one that could stand to be updated. This is, of course, the dot plot. But this will really be the most important part of the meeting because there's really no expectations at all for any kind of rate change or any super meaningful content change to the announcement. So,
can I just quickly ask before you go on? In terms of these forecasts, do they have to supply these forecasts under law? Or is it down to the Fed themselves?
It's down to the Fed themselves.
Okay.
And they can change it, modify it, however they want. They would want to give everyone advance notice about how they're going to do it. And that, of course, is their style. So what we can expect to see is we had the GDP. Well, the most important one will be how many rate hikes are we going to be getting this year. The last one in December moved it down from 3 to 2, which was the first incremental shift toward the neutral. Before that, they had been signaling that they would be raising rates 3 times, or 3/4 point rates would be the interpretation. That moved down to 2, and now are we going to, in December, what are we going to get now? I mean, are we going to get 2 as expected? No, we're definitely going to be trimming that down at least to 1. And perhaps for the next year, where another one had been expected, maybe we'll actually trim that down too. So that'll be the first place to show it. And, in the Fed speak, it's always a little bit awkward. So their number is 2.9% for the federal funds rate by the end of the year. Right now, we're at 2 3/8. So that 2 9 is really 2 7/8. So that is, we can expect that then to be down in their terminology, maybe to 2.8, which would be 2.75, something like that. That would almost be certain that you're going to have to move that number down. Otherwise, there'd be a complete conflict between what the Fed's guidance is and what their FOMC forecasts are. And also GDP is also up for grabs here. Their last one was 2.3%, which isn't which is a nice, moderate, sustainable rate of growth. But that may be coming down. Their 2020 forecast is 2.0%, going down to 1.8%, and the longer run, which is another element they have, is 1.9%. So you might be seeing them trim that down a little bit. Whether or not this is going to be an explosive market moving event, I really seriously doubt it. So it's kind of a wait and see. I think if they do say anything and there is a surprise, it's going to be on quantitative easing, and they're going to be pulling that back, and the tightening part. And so that is up for grabs, and how that is explained, of course, the less of the tightening they do, the more accommodative they will be, which would be in line, I think, which is their step back approach. There's a lot of factors in the economy right now which are maybe losing steam. Certainly, maybe the manufacturing sector, given global slowing, maybe that's losing steam. Certainly, consumer spending isn't showing any life. Housing isn't outright struggling. The Federal Reserve, FOMC, doesn't put a lot of stress on the housing sector. Maybe they will in this meeting, either in their announcement or in Powell's press conference. And any stress there would also be in line with kind of a stepping back, cautious. Let's not disrupt the economy.
Right. Is there any expectation that they may come out with sort of I don't know what you could say, a hard target for the balance sheet for year end?
I don't know. I mean, anything is up for grabs. They could do a target size. They've more or less confirmed, and I mean more or less in between the lines, that they're talking about something in the in the $3.5 trillion range for the size of their balance sheet, where they want to see it. Right now, it's just under $4 trillion. So that would still be a significant amount of runoff through most of the year to reach those levels at their current rate. They could provide a target. They could provide an end date. And there's always the possibility that they could shake up the markets by our expectations by actually announcing an end date, or actually announcing such a target. And in that case, I think you would probably see a big rally in the stock market. But I wouldn't say that's their style. I mean, it would be another indication of something like that would be approaching sometime sooner than later in their kind of lingo.
Okay, are you looking for a unanimous decision? Everything
has been unanimous.
Agreeing with the boss?
Everything. Powell has managed to do this since he started at the beginning of last year, to get every single vote on his side. He's really unlike Brexit, for instance, he's able to get a coalition, a very, very strong coalition. And this is the time of historic controversy for the Fed, given President Trump's criticism, open criticism.
Sure.
On a public level. So this kind of like circling the wagons kind of thing. And he's managed to pull that off.
Okay, well, all right. Well, let's just stick with the central banks for a moment, at least quickly touch on the Bank of England and the Swiss National Bank. Although, to be honest, the chances are they won't be overly interesting. As far as the Bank of England's concerned, then on Thursday, expectations are, well, what can they do when the Brexit fog is as thick as ever? Because let's be honest, their prospects of calling the outlook for the economy accurately is about as high or as low as anybody else at this stage. So very much then the market looking for no change in bank rate. So that will remain at 0.75%, and no change in quantitative easing, which is under under the Bank of England's forward guidance. That's kind of a done deal, because they're still saying that there won't be any change in their quantitative easing, the stock of quantitative easing, until such time as bank rate is much closer to 1.5%. So in other words, another 75 basis points above where we are at the moment. So I guess the main thing to look at there will be, apart from whatever they have to say about uncertainties surrounding Brexit, etc., is whether or not they're going to change their current bias, because at least as far as things currently stand, they're still intimating, of course, dependent upon Brexit, that the natural move in UK interest rates is still towards the upside, because they still believe that the inflation target, the 2% medium-term target, could be under pressure given what remains a very tight labour market.
Jeremy, can I ask a question? Do you think the pound really took off last week? Now, is behind there a subtext of what you were just talking about, a Bank of England bias to the upside in the rates?
I think you've got to say that that's providing the pound with some underlying support. But, realistically, the pound movements last week, and indeed the pound's movement over the last several months, if not the last couple of years, has been so tied to Brexit, it's not true. I'll have a quick chat about Brexit in a minute. But really, there were some sort of favourable developments from the political sphere last week, which, as far as, those investors who really want the pound, well, I should say the UK to either remain in the European Union or at least emerge from a European Union with a good trade deal, developments there were quite positive. But I think it's perfectly fair to say that if this Brexit really does sort of, go the wrong way, then the idea that the bank will hike interest rates or might hike interest rates has got to be supportive, particularly against the kind of background you were talking about with the Fed, where, trimming Fed tightening, and the likes of the ECB, where all of a sudden now, people actually starting to contemplate the possibility of additional easing. So there's got to be at least a plus factor for the bank. What else we've got? On a similar sort of vein then, the Swiss National Bank, and really they haven't moved policy for yonks now. It's been a long time since we saw anything coming out of them. And it's really back down to the currency as well. As far as the SNB is concerned, they'd still like to see inflation higher. They don't have a specific target, but ostensibly they'd like to see inflation running close to the 2% mark, so a bit like the ECB. As we speak, headline inflation is only at 0.6%. The core rate is only at 0.4%. And their big problem, of course, for some while now has been the strength of the Swiss franc, which has dampened down import prices. It's also helped to dampen down the economic activity to some extent, and that's been crucial in keeping inflation low. Since the last meeting, and the SNB only holds quarterly meetings, unlike most central banks, the exchange rate has been relatively stable. So that's at least eased some of the would-be pressure on them to come out and make their interests even more negative. I just quickly mention that their target range for 3 months Swiss franc LIBOR, that's still minus 1.25% to minus 0.25%. And their key so-called deposit rate, that still stands at minus 0.75%. So despite the fact we've got very negative interest rates in Switzerland, it's the currency itself is still perceived as being the safe haven currency instrument across Europe. So when there's any kind of geopolitical problems or uncertainty about Brexit, whatever it may be, the Swiss franc tends to see these strong capital inflows. That hasn't been happening quite so much of late, despite all the Brexit stuff. So I think it's pretty well a done deal that the SNB will also vote to keep interest rates on hold again on Thursday. There won't be any real surprises there.
Okay, so can we turn to Brexit now?
Yep.
And when we do, I have a question. And there's been a rule that you can't have an identical vote
Yes.
on the same in the same group there. But why would they even want to have the identical vote? They lost it by a large degree, and the subsequent votes were all came in as expected. Was there any expectation that even if they did take a second vote, that anything would be different?
Now, that is a very, very sensible question. Now, let's quickly put this into context. So people, I'm sure, are becoming used to these so-called meaningful votes. The second meaningful vote took place last week on Tuesday, and Mrs. May managed to lose that one by 391 to 242, i.e. a whopping great 149 votes. Why, might you ask, and indeed Mr. Pender did ask, would you bother putting this thing forward again unless there's any proper changes to it? And as you mentioned, this is what the Speaker said. The Speaker is effectively, in the House of Commons, he's the guy, the most important person really outside the Prime Minister, who determines what bills and what Parliament procedures go through. So if he says Mrs. May can't put this effectively same bill through again unless there's some significant changes made to it, it simply can't go through unless they change the rules somehow. Now, Mrs. May's point of view is, I suppose it's, or more and more, it looks like a case of brinkmanship. So, as we know, as it stands at the moment, if she's to put it through again today, she'd lose it. However, what she's hoping for is that the closer we get to Brexit Day itself, and say that's what, just 10 days away now, there are going to be those Brexiteers who start thinking, well, as of last week, Parliament, okay, it's a non-binding vote, but Parliament voted heavily in favour of rejecting a no-deal Brexit, which effectively means that almost certainly, come 29th of March, Brexit Day won't happen then. There's going to be an extension. Now, if you're in favour of Brexit, want to see want to see the UK out of European Union as soon as possible, the big worry now becomes that if there's an extension to Brexit, how long is that going to be? The danger is at the moment, and I think as we understand, Mrs May is currently writing the official letter to the EU now requesting a Brexit extension through to the end of June, if she can get her deal through, or something longer if she can't. So the worry amongst the Brexiteer camp is that, well, if there's an extension, let's say as long as 2 years, I mean, heck knows how long it could be, will we actually ever see Brexit taking place in the first instance? And if that's the case, are they then better voting for Mrs May's deal, which at least means that Brexit does take place, albeit not as they want to, or at least not in the same fashion they want to, or simply risk the fact that Brexit might never happen? So I think it really is a lot of kind of in-house politicking going on here. And Mrs May realises at the moment she doesn't have the support, but she may win the reluctant support of the Brexit camp just because they become scared that Brexit might never happen.
Can I ask now, you mentioned in-house, and is it really true that the EU also has a call on this and that all 27 members have to agree on a new date?
Yeah, that is right. So effectively, Mrs May will put... But the next step is that Mrs May will have to write to request an official extension. The shape of the extension is supposedly partly negotiated between the UK and the EU. But as you say, for an extension to be ruled upon in the first place, each EU member, so all other 27 members of the European Union, will have to give it the nod.
And can they abstain? Yeah. I mean, well, is there a risk that you can't get 27 votes?
There is, but I think it's unlikely in the sense that there's not really any individual country which wants to see, the UK fall out without any kind of a deal. Because as bad as it is for the UK economy, it's going to be bad news for the rest of the European Union as well.
What about France? France isn't seeming so agreeable.
France has always a sort of, banging the drum, but by the same token, even Macron isn't interested in seeing a no-deal Brexit. There's a massive amount of trade between the UK and France, and the idea is suddenly sticking tariffs on all sorts of goods and services. It's going to be negative for the UK, and it's going to be negative for France as well. So the real issue is at the moment, well, what do we know since last week? What's actually changed? In terms of the Mrs May's Brexit proposals, absolutely nothing. They're exactly the same as they were last week when they were basically just shot down. We do know now that it's much more unlikely that there'll be a second referendum, because one of the amendments which were voted on in Parliament last week was turned over quite quickly. It doesn't mean to say we can't have a second referendum, but the time being, at least, that looks to be fairly unlikely. And also the idea of a no deal, well, Parliament is clearly against that. But, as we've said countless times in the past, as we currently stand under UK law, the default position, as if nothing has changed by the time we get into the 29th, so next week, then the UK will be leaving the European Union with or without a deal.
Okay, so let's talk about the pound now. Is it, buy in the rumor, sell on the fact? If we do get this extension, would there then be a retreat in the pound?
I don't know. It's a good question. My gut feel is that if we do get an extension, then there's going to be at least some kind of mini relief bounce. I think we've seen the pound hold up, particularly against the euro, the kind of the bellwether gauge we talked about in the past. The pound's actually held up pretty well through all this lot. It's been very volatile, certainly, but put a straight line through it and it's actually done pretty well. So there must be some good news already built in there. So this is, as you say, buy the rumor, sell the fact. But at this stage, it's still not clear what's going to happen. So personally, I mean, as I speak, sterling euro is trading at about 1.168. We've been almost up to 118 during the course of the last week or so. So I think if we were to get the news that, yes, an extension has been, let's say, even if it's just through to the end of June, that gives markets, a chance just to get their breath back and think, well, okay, if it gets to the end of June, perhaps it'll be extended further. Who knows? Perhaps we won't leave the EU, and that would be bullish for the pound. So at this stage, even though the pound is actually, trading relatively well given the uncertainty, I still tend to think there's a little bit more upside to it. But it's got to be said, if this thing all falls out of bed and they can't agree something, then yes, I mean the pound could come off easily 10% very quickly.
Whoa, that would be an amazing move.
Well, it's an amazing move, yes, but I think if we go back to the referendum, where are we? Back in the middle of 2016, the pound went from, I think back now, we had on sterling dollar, we were trading at about 144, and within a space of a couple of days, we were down about 128, 125. There's a similar size move in a shorter space of time against the euro. So it would be hugely volatile, and it really would be a major shock to financial markets globally.
And certainly certain firms might not be able to survive such a sudden move like that.
Yeah, that's completely true. And one of the issues over here, of course, has been this contingency planning. We know there's been a lot of stockpiling in certain areas, but that doesn't help every firm. So yes, it would be your proverbial right royal mess. Okay, well, I suppose that's as good a point as any to leave, isn't it? on that happy note, yes. Anything else from your side?
No, we're just waiting for the FOMC. And the data's been soft, and really that's why the Fed is going to be standing aside, and we're all just with our jaws gaping open watching Brexit.
Right. Okay then. Well, so let's wrap it up there then. As ever, on behalf of Mark and myself, thank you very much for listening. I'm going to pop out and buy myself a tin helmet, and we look forward to doing it all again next week. Bye for now.
Econoday has provided value for the investment industry for over 25 years, amassing a comprehensive, machine-readable database of global market events. Our exceptional dataset consists of consensus, actual reported and revised numbers of economic events. Algorithmic trading firms, global banks, asset managers, hedge funds and AI technology firms are leveraging Econoday's unique historical dataset to fuel their proprietary trading models and support their research and compliance teams. Go to www.econoday.com and follow @Econoday on Twitter to learn more.